China's foreign reserves slipped below the $3 trillion level in January, the lowest level since February 2011. Since lagging economic confidence and the rising trade protectionism throughout the world, the implications of the decline of China's foreign reserves remains to be seen. To discuss the many issues related to this, I'm happy to be joined in the studio by Michela Garatti, head of the China Economic Policy Program with Nottingham University.
China needs to reform its financial system. The decrease in foreign reserves and the depreciation of the renminbi could be worrying signs, but my view is that financial reforms should be done slowly.
And Professor Zhu Ning from Shanghai Jiaotong University, and he's also the Deputy Director at the National Institute of Financial Research.
I think RMB exchange rate will keep fluctuating in 2017 despite the more directional move or decrease in China's foreign reserve.
That's our topic. This is a dialogue. I'm Yang Rui. But before we get started, let's look at this.
Dipping below $3 trillion in January, China's foreign reserves dropped to their lowest level since 2011. It's the 7th consecutive monthly drop, with the figure falling more than $10 billion in January this year and more than $40 billion in December 2016. The central bank cites the supply of foreign exchange funds as one of the main reasons for the recent decline in the country's foreign reserves. On the other hand, there's usually an increased demand for foreign currencies during Spring Festival because many people visit overseas destinations during the holiday. The appreciation of non-dollar currencies in the same period partially offset the reduction in the dollar-denominated reserves. Chinese capital outflows have accelerated in recent months with the yuan's devaluation against the US dollar. If forex reserves fall below key levels, it may put additional stress on the currency. However, the $12.3 billion decline has been the smallest decline in 6 months, equivalent to 1/8 of the decline in the same period last year, a slowing trend.
It is expected that the size and openness of China's cross-border capital flows will increase as the renminbi is added to the basket of SDR. Two-way flow and the basic balance of the pattern will welcome new support factors.
Rather than being a source of worry, the drop in China's foreign exchange level is considered one of the steps to safeguard the healthy development of China's economy. Stabilizing the exchange rate in the short term is a comprehensive strategic consideration for trade, finance and diplomacy.
Welcome to Dialogue, gentlemen. There have been more worries about the financial stability since our foreign exchange reserves fell below the mark of $3 trillion. Do you think this is a logical concern?
It is a concern because the world has been used to China accumulating reserves. The main worry is not the level of reserves, but the trend. It doesn't really matter if it's 2, 2.5 or 3 trillion. The main issue is that what used to be a safe bet on an upswing of reserves coming from FDI, from the double account, current account and capital account surplus, now is becoming a double, well, not quite yet, by deficit on the capital outflow. And the main worry for me is when is the capital account going to turn negative? So my worry is not really what is the amount of foreign reserves, but what does the trend in foreign reserves tell us about the domestic economy and the confidence that Chinese investors have in their own economy. And so why is it that they expand and invest abroad in such a large number so that it counterbalances the still very, very positive inflow of capital coming from the current account, the trade surplus? So
it goes without saying that the majority in China, not many of them are professionals in the financial industry, point out that the strong foreign exchange reserves, which number $3 trillion, is actually a strong hallmark of China's economic strength. Now, if it dips below $3 trillion, it means the economy may not be sustainable. What do you think of our concerns?
Well, I think the 3 trillion watermark is more symbolic than substantive. I think, be it 3 trillion or 2.99 trillion, it doesn't really make that much of a difference. However, the point is valid in a way that I think I agree with the other guest. I think we're seeing the foreign reserve drop from 4 trillion to 3 trillion, and that trend is largely one directional bet. I think that is what concerns people with two reasons. One is, I think, going back to the game of confidence, I think why is it all of a sudden shifting into the other direction? There's a very good reason, which is the shifting growth model of Chinese economy, which means that China is relying less on its export and relying more on the domestic consumption. So in that sense, it is actually an encouraging sign that we're successfully going in the path of relying more on domestic consumption rather than export. So I think that is sort of mixed. What I'm pretty much concerned is the second point. The decrease in foreign reserve is happening despite the many attempts to try to stop the flow out of China. I think there is increasingly tighter control on the capital flowing out of China. I think we're still seeing, even after correcting for the appreciation value from the appreciation, the strengthening of US dollar, we're still seeing, even after we're adjusting for the valuation factors, we're still seeing a net flow of capital out of China. I think that is what is concerning, and that is making people worry about, well, if we're going to lift all those constraints, is there going to be a capital flight out of China? I think that's a bigger concern we're having.
And do you think the Chinese authorities have actually been wrestling with the idea whether they should make a choice between maintaining the exchange rate and foreign exchange reserves? Is that a real choice for us?
You're right. There is a choice. We know from theory that China cannot have the cake and eat it. So either you keep the floating currency or you close the capital account, and you have to give up one of those two in order for you to have the other one. My view is that the amount of foreign reserves, $3 trillion, let's put into a context. The foreign exchange market every day trades about $5 trillion US dollar in value between US dollar, yen, pound, and euro. So the four main currencies in one day exchange $5 trillion of value, almost 1.5 times, twice the value of the overall reserves in China. The GDP of the United States is traded in a few days. So if we look at foreign reserves as a way to defend their own currency, if a currency is a truly international currency, like the pound, like the dollar, there is nothing that any central bank can do to defend its own currency other than closing the door. And we saw this with the UK, with the EMU, the crisis in Europe. So China can defend its own currency either by buying it, but the war chest cannot be big enough. It will last 2 days. I'm exaggerating. It will last a few months, but not so long. Or close the capital account. But closing capital account is tricky, because on one hand, you also want the positive effect of the diversification. Because yes, taking money out of China could be bad if it is because people say, oh, I don't trust the Chinese economy. But there's also a very positive side, which is diversifying into other geography, other assets, other currency. And so there is a positive side. So this is the trick, to balance how much capital should go and why it is going out. Big challenge. Very easy for us to sit here and say what safe should do or how much capital should go out. But the thing is that China, I think, fully understands is that you cannot control the value of the currency, and at the same time you have to give up the control on capital.
I just have one minor things to add to what you have said. I think it's a matter of again going back to. Well, the foreign reserve itself is not large enough to maintain the exchange rate, but it is I think that the symbolic power, the might, the ammunition that the central banker has in its hand. I guess the counter question that we should ask ourselves is, without the foreign reserve, what would happen to the exchange rate? So in some sense, I think people have been debating about whether we should try to sacrifice some of the foreign reserve to secure the exchange rate, or let the exchange rate so that we can keep the 3 trillion foreign reserve. But then I think eventually the question will be, without foreign reserve, the central bank will have very little to say about exchange rate. So I don't think those two questions are either or. I think that's one question just having two different manifestations.
Let's take a closer look at the exchange rate or the exchange regime. President Trump, as well as many of his predecessors, accused China of manipulating the currency. Do you think this is true?
No. You know, when President Trump talks, and in fact any politician that talks, they talk to their own electoral basis. They do that to gain votes. We have the same in Europe, in Italy, people saying things against, they need to find an enemy, because the economy doesn't do well with high unemployment, with economic crisis. You need to find an enemy to blame. And it's very easy to...
actually a practice of protectionism.
The price of protection is actually, this is another trick thing, because in a way we have been used to the idea that in a liberal economy the country gains from trade. This is not always true, however. So there is also in protectionism, there could be also some positive advantages. China, we have, if we export goods from the West into China, we have to pay taxes. So China, in a way, does not have its door fully open. It has some forms of protectionism.
But do you agree
and China has done very well with that. So protectionism has helped China.
Do you acknowledge that China has been a liberal economy?
What do you mean liberal?
Because you say a liberal economy largely relies on trade. China has become the biggest trading power in the world. Maritime trade, for example, accounts for most of what we do.
China has gained a lot from the liberal trade, and it has done another thing which is relatively good, which has an internal...
You are being a little bit philosophical. Give me a short reply. Are we a liberal economy?
70%.
70%. Is that one reason why both the European Union and the United States refuse to grant China's full-fledged market economic status?
Yeah, I think I tend to agree with the other guys. I think if you just look at the trade side, I think we're pretty much a liberal economy. But then if you look beyond what is behind the trades, I think the SOEs, the large export subsidies that we're receiving, I think that is probably what the foreign governments are paying more attention to. And going back to your question about...
Excuse me, but does it make sense to... For example, for President Xi Jinping to defend globalization and free trade externally, but internally, we cannot rely on liberal market economy. You're right when you look at the powerful role and presence of the SOE.
Well, I think there are probably two ways of looking at it. One thing is, well, almost all countries in the world manipulate their currencies or have some kind of trade frictions. I mean, this goes even back to, the U.S. If you think about the quantitative easing of the Federal Reserve, that is sort of manipulating their own currencies as well. So going back to your original question, well, yes, there is some inconsistency, but the one thing is China has come a long way from a strictly central planning economy to what it is currently doing. So I think that is, we cannot require this to be the same as the Great Britain or the US.
So to be more precise, Michaela and Junying, is it more accurate to say that China's economy is a transitional economy? It's neither a liberal economy nor a central planning one.
I agree with you, and I tell you something, there is, we always make this joke when we do this statistical analysis. If you can look China in two ways, as a cross-sectional, comparing China today with other countries today, or you can do a time series comparison, that is comparing China today with what China was before. And depending on which method you use to do the analysis, you come up with different answers. If you compare China today with what other countries do today, of course China is behind, it's not liberal, the SOE dominate, it's not competitive. If you look at China, what has achieved in the last 20, 30 years, then you say, chapeau, hat off, much more improvement, and because we don't care about the past so much, but we do care because it helps us predict the future, then we see that this path is going in the right direction.
Now, gentlemen, our discussion seems to be getting more sexy as we look at the subtle relationship between the market and the government. Professor Lin Yifu argued with Professor Zhang Weiying that he stands for more intervention from the government, whilst Zhang Weiying, Xu Xiaonian, Mao Yushi, these liberals argue just the other way around. Now, which side do you take?
I think I take the more liberal side. I think, I've been making quite a few comments on this topic in a way that, well, if you truly trust the power of the government or a planning power, then I think we don't have to go very far to look at the former Soviet Union and the former Eastern European countries. They set a very good example. The former Soviet Union, they have famous economists who have won Nobel Prize for advocating the power of central planning. But then look at what happened to the Russian economy. I think it's really the power of the economy that is dragging down the entire sovereign government. So in that sense, I think there are limitations and failures of the market, but what I'm more concerned about is if you have put the government into the place of the markets, the government may not be able to do as good a job as the market, even though the market itself is not perfect.
But I'm afraid China is not the only powerful government that stepped into the market. If you look at what Franklin Roosevelt did in the last 30s, right, in the 20th century, that's the New Deal of the presidency during the major economic crisis of the 1930s and 40s. You are watching Dialogue with Michele Garatti and Zhu Ning. We're discussing why our foreign exchange reserves have fallen below $3 trillion mark. Does it mean a big deal for our economy above all? We'll be back in a short while. Welcome back, gentlemen. What's your sense on what's going to happen next during President Xi Jinping's administration? Will, for example, the economics get anywhere? Because the essence of economics actually emphasizes that the market forces should be allowed to play a decisive role in reallocating resources. Now, do you think this idea is getting anywhere?
This is a difficult question because every country lives in different stages of its historical, social and economic development. So whilst I agree that in the long term a liberal economy with little little government intervention would be beneficial, there are timing and extent of this retreat by the government that needs to be carefully planned. So if you ask me, should tomorrow morning the government step out completely of the Chinese economy? No, it would collapse. If you tell me, should we look at 50 years from now and make it look like England, then I would say it would make sense. So the timing is maybe more important because we all know that the liberal economy does tend to work until, of course, it doesn't. So, for example, take Trump. Trump knows very well the liberal economy works. However, he said, you know what, guys, we don't have an internal mechanism to redistribute wealth between the rich and the poor in the United States. So what we do is we raise barriers to trade. We become a little bit more protectionist, which is against the theory. The country suffers, but the average, the poor, gets a little bit more rich at the expense more of the rich. So there is a big transfer.
China is quickly becoming a middle-class society, olive-shaped middle-class society, which is fast becoming a big army of consumers. And they demand justice, social justice, rule of law. And therefore, do you think this formidable force of the middle class will have more tolerance for the SOE, more government intervention, instead of rule of law, which would protect all players on an equal footing in the market economy?
I think if people become middle class, we look at the ages of these people, probably going to be 40, 50 years old. They probably still remember that 30 years ago they did not have too much to eat, and surely there was no iPhones available. And upsetting the current status in exchange for something even better, which bears the risk of destroying all the good that has been done so far.
Let me go back to the issue of the exchange regime as well as foreign exchange reserves. Is it necessary for China to diversify foreign exchange reserves by not just pinning our hopes on US dollar? Instead, we can, for example, buy more Japanese yen, euros, and sterlings?
Ideally, we should, and I'm sure the PBOC, the SAFE, have been trying very hard to go into that direction, but there is one realistic constraint, which is the U.S. Treasury market is far greater than, in terms of size, than any other financial securities market in the world. So, I mean, even if, especially given the humongous size of China's reserve, I mean, it's really, whenever we're trying to buy a little bit more euro or buy a little bit more yen, we'll see the market move along with whatever China is trying to do. So I think, yes, we're trying to move into that direction. That is particularly being reflected by the PBOC's declaration about it is not trying to target the US dollar versus a basket of foreign currencies as its target for stabilizing stabilizing the RMB exchange rate. So I think we are moving into that direction, but there are a lot of realistic constraints and the challenges.
Is it true that Japan has surpassed China to become the biggest debtor nation, holding the biggest dollar-denominated foreign exchange reserves?
Yes, yes.
And what does that mean? Because Shinzo Abe, the Japanese Prime Minister, has just been to Washington, and with a hat in hand, he wants to sound out Trump's attitude towards the TPP, as well as whether the United States would honor the Security Pact, which is regarded as the cornerstone for ensuring the regional security order. Now, Japan has been involved in a very tough competition, vying for regional influence against China. Now, psychologically, do you think having the biggest holding in Federal Reserve will help?
Not at all. Because as we said, we're talking, I know for me it's a lot of money, $1 trillion, whatever the Japan central bank owns in the US dollar. For the US economy and for the FX value that we discussed before is nothing. And it will not swing the view of the United States policy just because there is a new shareholder. Because, by the way, if you give in to Japan today, you will have to give in to the next shareholder tomorrow, and then on to someone else. And so because the US continues to issue bonds, you said the market is very big and will get bigger. The US needs shareholders, and they themselves need to diversify their shareholder basis, so they are not depending on a single one. At the end of the day, you know what, all these bonds, they yield nothing. You know, interest rates are zero, negative in some cases. The Deutsche Bund is negative on, you know, maturity up to 10 years. So this is really a little bit of a facade of getting currency into one of the other denomination, but it does not swing the political power of Japan towards the United States. Power that Japan has, but not because it owns some T-bills.
And also, I think there's a distinction between, in China, most of the foreign currencies or foreign assets are being held by the state, whereas in Japan, I think it's a combination of the state held and the household held. But then the household or the corporations, they would not necessarily move in exactly the same direction as the state. So.
Though the market is not optimistic about it, the U.S. Federal Reserve promised recently to raise interest rates in the coming months. Why did the U.S. Federal Reserve make such a promise?
Because they need to give the signal that now we live in an opposite world. When interest rates go up, it's a good news, because it means that the Fed has confidence in the economy, they're not worried about lack of credit, liquidity, credit crunch, and so they feel confident to raise rates. So now this is the new rule of economics. Yeah. When interest rates go up, good news for the economy.
But I'm afraid a strong US dollar, a result of the resilient US economy, will necessitate the depreciation of the RMB. Is that the logic?
There may be such a pressure on, I think, the exchange rate of RMB, especially given what we have seen in the later part of 2016. But I mean, let's pay attention to two things. One is, well, it is not a direct connection in terms of the US dollar exchange rate versus the RMB. If you look at what the RMB exchange rate has been doing in the past month or so, it's actually quite independent of where the US dollar is headed. So I think that is one thing. The second thing is whether or not it is a wise decision to maintain RMB at unnecessarily high level. I think that is the more important question we have to ask ourselves. And going back to your earlier question about, is China manipulating its currency? I think that's a very odd question coming out of the US, because several years ago, US is accusing China of manipulating its currency because they think the RMB is being too weak. But now they're saying RMB is being too strong. So which way do you want China to go? I think so that is a little bit, I think, groundless. But for China, I think the question is, how can we convince the rest of the world that we're not manipulating? I think by gradually
by opening up the capital account,
yeah,
for example.
Exactly.
There is an easy way, which is not good for China, by the way, is opening up the capital account.
Exactly.
And my old professor of economics, Professor Dombush, used to say, the moment the country opens up its capital account, it lets its monetary policy in the hands of a 20-year-old guy in Wall Street, like with suspenders, like Gordon Gekko in the movie, pushes a button like it did in the UK, and the country is on its knees.
But
so we don't
gentlemen,
want that
we have taken a bold step, a major one, in the correct direction by establishing a special zone in Shanghai, and likewise we did the same in Shenzhen. Do you think this foretells something positive in the correct direction? And that's the silver lining, if not the silver bullet at the moment.
If you want direction, not far enough, the step.
Because you guys are a little bit too demanding, I'm afraid.
You know what, if you want a currency area separate from the rest of the country, you need to have one border. You cannot drive from Shanghai to Hangzhou without border control. Otherwise, that's a trade zone, not a financial free trade zone. Because you cannot have interest rates different in Shanghai than you have in, I don't know, in Songjiang.
Originally, I think the hope was we'll
Let
have
me ask
far
you
more.
one simple fundamental question with regard to a comparison between the Russian economy and the Chinese one in the immediate aftermath of the Cold War. Russia, ironically, adopted the shock therapy, and we saw the free fall of Russian currency. But China adopted a step-by-step and gradualist approach instead of accepting a shock therapy, instead of privatizing our economy. And therefore, we became the second biggest economy and the largest trading nation. Do you think by experimenting with something bold, step-by-step, instead of turning to shock therapy, China will be even more successful, quite against the expectations of the liberals?
Little by little. That's been the success for China. 摸着石头过河, filling the stones, crossing the river by filling the stones. Russia didn't have any river. There was no other side. There were no stones. There was no river to cross. And this is, a very big fundamental. When we look at Eastern Europe, 89, completely blow up and big bang changes. And China did, it took 30 years and achieved more in the long run. If you want to go fast, if you want to go far, go slow.
And also, I want to emphasize that I thought this book coming out last year, titled China's Guaranteed Bubble, I think the point I was trying to make in that book is, yes, we have been enjoying really great economic growth in the past 3 decades, but that is coming at a cost of, I think we're just becoming more and more complacent by misallocating the resources more and more into the wrong direction. So without correcting that mistake, I think we may see, I think as the Communist Party is making it clear, the systematic financial risks might be looming around the corner.
Before we wrap up this very enlightening discussion, let me ask you what will happen after the very cordial conversation on the phone between President Donald Trump and his Chinese counterpart. Do you think our foreign exchange reserves are likely to increase a little bit? Because there's one assumption that by being the biggest debtor nation of the U.S., we have bought an insurance policy. It means the United States would buy the idea that we are economically very interdependent, and geopolitically that will help reduce the risks.
No, I don't think so. China and the US are indeed economically interdependent, and they need to talk to each other, but it's not because of the reserves. The reserves is...
Quite a few years back, I was asking Richard Holbrooke, former and late special envoy of the United States towards South Asia, whether it's a good idea to dump our foreign exchange reserves. He said, no, Yang Rui, that's not be very friendly. That won't be a friendly gesture. So what did he mean?
Because there's nothing else you can buy. You dump dollar and then you buy what? Exactly, there is no other market. Like you said, and the US market is the biggest. If you dump $1 trillion, $1.5 trillion, what do you do?
And there's another thing that
you
is...
cannot dump it.
I think in China, I think people are thinking, well, we're reducing our foreign reserve size. But people are thinking that we're reduce that to 1 trillion. No, but that's not the situation. I mean, in international finance, we want this to be at least probably 1.5 to 2 trillions. So that means that we only have that much, one additional $1 trillion for foreign reserve to deploy. So I think we're not that far away from the sort of tipping point or the threshold line. So that is also one thing to keep in mind.
Okay, thank you very much.
Pleasure.
With that, we come to the end of this edition of Dialogue. I'll see you next time. Goodbye.